Welcome to Talking Mortgages. This is HGG Radio. My name is Oral McLean. I'm the Mortgage MC. This week we have a information filled program for you as usual. Today we are looking at income, all you need to know. And we're going to have a very wonderful program for you. And as usual, you can contact us on 825-343-4486 via WhatsApp. You can call, text, or even leave us a voice message if that's possible, right? So, beautiful, beautiful program we have for you today. All right, so income, all you should know. All right, so you know that a mortgage is very important for a lot of persons in order for you to buy that dream home or just have somewhere that is nice and humble, because, you know, be it ever so humble, there's no place like home. All right, so mortgages and income. All right, as it relates to income, this is one of the more key areas in qualifying for a mortgage. What is your income? And there are so many different types of income and sources of income that is out there. So what we're going to do is that we're going to look at 5 of those sources or types of income that you will encounter, and how is it that we use these when qualifying for a mortgage. All right, so without further ado, just a reminder, this is HGG Radio. You're listening to Talking Mortgages, and you're with Oral McLean, the Mortgage MC. All right, so 5 types of income that we look at tonight. 1, employment income. 2, retirement income. 3, support income or support payments. 4, rental income. And 5, investment income. So those 5 areas are the areas that we will go into tonight. All right, so you're thinking of applying for a mortgage. One of the first questions I'll ask you as your mortgage broker is, are you employed? If the answer is yes, then we go on to, are you employed full-time or are you employed part-time? Okay, so based on the answer to that question, if you are employed full-time, I'm going to ask 2 more questions. Are you salaried, hourly? How is it that you are paid? And if you are salaried or hourly, as long as you're full-time, we need to look at what your income is. And your income is then represented in the following ways. 1 is that we're going to be using your annual income if you're salaried or as long as you're full-time, whether you're salaried or hourly, we look at your annual income. Some persons, however, even those that are salaried or hourly paid, from time to time will work overtime or get bonuses or other incentives that will increase the amount that they make every year. If we're just using your annual income, that amount is usually stated or verified through, say, a letter of employment that we would request from your employer. And that amount, say, for example, you make $100,000 a year, and that's your basic pay. However, you might get bonuses or other incentives, or you might work overtime. So if we're going to use that $100,000 that is stated in your letter as your income and then verified by your pay slips with the year-to-dates in it, right? What we will do is use that $100,000, and that is what we're calculating your income on as it relates to employment income, right? So if you're somebody that worked a fair amount of overtime, what would happen, though, is that now your income will view it in a totally different way. Because if we're going to include stuff like overtime and other incentives that you might be getting, this way, for us to track and have an idea as to what is the standard or the norm, we would then have to do a 2-year average of your income using either your T4s or your notices of assessment. And we do it for the preceding 2 years, right? So if this is 2023 and we are going to use your overtime income because you're either salaried or hourly paid, but full time, but because you make so much overtime and we don't want to use your basic income, which is smaller, we want to use your total income, which is more and which will enable you to qualify for a larger mortgage, to use the incentives, which is overtime or whatever else you're paid. We would do a 2-year average. So we'd take like 2021 and 2022 T4s or notices of assessment. We find the mean, which is adding both of them and dividing by 2. Right? So say in 2021, you made 115,000 because you made 15,000 extra in overtime. And in 2022, you made 125,000. So what would happen now when we add all those together? We'll get 240,000 divided by 2. So your income that we would use would be 120,000, right? And that's how we do it to ensure that you get your income is higher, because the higher your income, the more you're able to qualify for. The reverse of that is there's another example that I want to give you as it relates to full-time income when we are trying to use the higher income. So say in 2021, you made 125,000. And in 2022, you made 115, but your base salary is 100,000. We want to use the higher of it, the higher amount of the income. So what we would do now is that, unlike when we did it, when we just add both of them together and divide it by 2, we would not do that in this case. Because if in year 1 of the 2 years that we're using, your income was more than in year 2, what we do is just to use the lower income, seeing that is the current one. If it's lower, we use the lower of the 2. Right? So don't get it confused. If year 1, which is not the previous year, but the year before the previous year, is lower, and the previous year that we're using, which is year 2, is higher, we do the average, right? However, if year 2 is lower than year 1, we just use the figure for year 2, which is the lower of the 2. All right, good. So that's for full-time income. Then there's part-time income, right? And part-time income, we apply the same measure that we would do to include your incentives and your overtime, which part-time income, you have to be employed to that employer for 2 years. And what we do is we do a 2-year average of the 2 years preceding the year you're applying for the mortgage. So again, we'll use your T4s, our notices of assessment, and we would add year 1 and year 2, divide it. If year 1 is lower than year 2, divide it by 2, we find the amount. If year 2 is lower than year 1, we use the year 1 amount, because then that is reflecting the current situation, or at least the closest thing to the current situation. And so that is for part-time income. There's a hybrid, because sometimes you have persons who will have both full-time and part-time income. In a case like that, what we probably do is just to apply the 2 rules just the same. If we're using the basic amount, we use the basic amount, and then for the part-time, that's for the full-time, and then for the part-time, we use a 2-year average of that. We add both of them together, and that's how we come up with your total income. All right, so that is for employment income. All right, and for employment income, what we have to verify this. So we use a letter of employment. We use like the last 3 or 4 pay slips, and T4s, notices of assessment, T1 generals, things like that. All right, so let's move to retirement income. And you might think that persons who are retired are not able to get mortgages, but they can, because they too do get income, right? They get the CCP, and and they might have interest coming in from their RRSPs. And if it's coming in on a regular basis, that is income, right? So what will happen is that we can use this income and apply it just the same as we have done with the employment income, and we will come up with this. So even retired persons can apply for mortgages, and they must be approved as long as they meet the requirements, because you cannot discriminate against a person based on the fact that they're retired because they're over 60 or over 65. All right? So that's retirement income. And it might be that some persons have retired, they're getting a pension, but they went back to work. So again, we can then again use both their retirement income and their employment income. All right, great. And the retirement income, we'd use documents like their CCP statements and stuff like that to show. Plus, we'll also use the lodgements that go to their account with the deposit that goes to their account with those payments. All right. Number 3 on the list of types of income, support payments. And support payments can be a few things, right? Like alimony or spousal support, child support, and of course, the Canada Child Benefit payment that persons receive from CRA. Alimony, pretty straightforward. Husbands or wives get that from their other half when they split up. And what happens here is that you need to prove that this is going to last at least a minimum of 3 years. You need to have a signed agreement or whether or not you get an injunction from the courts. So the documentation has to be there. It just cannot be word of mouth that, my husband and I, we split, or my wife and I, we split, and I get $1,000 a month as spousal support. Can't be just that. You have to have the documentation. Plus, we can also look at the bank statements to see the amounts going in on a regular basis. So it can't be that they paid January and then paid November of that year. It must be based on the agreement where it is going in, whether it is bi-weekly or monthly or whatever the case might be. Similar case with child support. A lot of times for child support, what we use to verify this is like a court order or some agreement that is signed by both parents that is ratified by a lawyer or like a justice of the peace. And again, we like to make sure that this is something that is outlined, that is going to be for like more than 3 years. And we can also use the bank statements to back that up. Then there is the Canada Child Benefit. And the Canada Child Benefit is paid out from CRA, and it is paid to mostly mothers. I was going to say parents, but it's paid to the account of mothers of children who are 18, who are under 18. And thing is, when it comes to mortgages, most lenders will use the CCB for children as long as during the first term of that mortgage, they won't become 18, right? So they'll still be under 18. Some lenders cut it off at 13, some cut it off as 12, right? And with CCB income, you have some lenders will use the entire amount, but some will use it if it's 30% of the total income. All right, so, and again, for CCB, the verification for this is that there's a statement that you can go into your CRA account and you can print that off. It outlines how much you get on a monthly basis for the entire year, and it's usually from like July to June. So it spreads across 2 years. And the other things that we use to verify the CCB payments is we need to verify the age of the children or the child that the CCB payment is being made for. So we will use like birth certificate, passport, Alberta Health Service, Alberta Health card. And we also, for this one, do the verification by also using 3 months bank statements showing at least 3 payments from CRA to the account of the person who receives the payment on behalf of the children. So that is support income. And there might be a few others, but these are the popular ones. And just to remind you that you're listening to HGG Radio and you're listening to Talking Mortgages. My name is Oral McLean. I'm the Mortgage MC. And the numbers for you to participate is 825-343-4486. And you can do that via WhatsApp from anywhere that you are. And we will be more than happy. If you have questions, we'll be more than happy to answer them. And it doesn't even have to be on the topic that we're doing today, because we're all about mortgages every day, all day. All right. So number 4 on our list is rental income. And rental income can be for a current rental property or for a potential rental property. And I'll make the distinctions, but let me speak about the current rental property. So some persons will own a home and they rent a part of it, right? The common thing is that you might have a legal basement or a basement that is not regarded as a legal basement, but it has a separate entrance, right? And the renter does not have to come into your area. You don't have to go into their area. So that is perfectly normal. Lenders will accept that. At least most lenders will accept that. And that is what we call a non-conforming suite, which is that it doesn't have a separate furnace to provide heat, or it doesn't have a separate electrical and things like that. However, it is a separate space. So that is acceptable by lenders. So perfectly okay. So, or some persons might have a separate property that they use as an investment property or a rental property, and income from that, we can use it towards your total household income, because what we do then is that we ensure that the rent is able to cover the mortgage payments, property taxes, insurance, and maintenance, right? So, and if there are condo fees, that is also included. So if it covers that and there's money left over, so there's a surplus, that surplus is then added to the rest of the income that you have, whether it is employment or otherwise, is added to that to form your total household income, right? So as long as there is a surplus after you take all the expenses that that can be attributed to that property, the rest goes to your income. Even though we're talking about income, if in the case where the rent does not cover all of those and there's a deficit, that is not added to your income, right? What that is, it's added to your liabilities, right? So it will then work in the opposite as adding income. So that is for when you already own the property. But say you're planning to buy a property and it has a suite in the basement that you're able to rent out because it's a separate suite. What we will do is that whatever the potential income is of that suite, we can, if you're going to be living on the property and that suite can be rented, we're going to take whatever is rented and we can, in some cases, add all of it or 50% of it or whatever percentage of it, depending on the lender, add that to your income. And even though you haven't owned the property yet, but because you plan to own the property and you're getting a mortgage in order to buy that property, then we can add that to your income. And that is a way that a lot of persons can work it, that they can afford a property that they would not be able to afford if it didn't have a rental suite in it, right? So, and that is pretty significant. Again, just to remind you, you're listening to HGG Radio. My name is Oral McLean, and I'm the Mortgage MC. And you can participate asking any question you want, whether on the topic that we're on today, which is income, or anything to do with mortgages, at 825-343-4486. So before we move and go further with the next item on our agenda, we have two questions. And question number one is asking whether or not we can use the rental amount to add to the income if the rental unit does not have its own entrance. And the short answer to that is, unfortunately, no. If it does not have its own entrance, so say, for example, you have a roommate, because this is almost like a roommate situation, right? Yeah, because what will happen if it doesn't have its own entrance, that person, to get to their space, would have to come through your space, right? And what the lenders look at is that if the space is not exclusive to them, right, meaning that they don't have to come through your space to get to it, then that is not considered something that they would accept the rental amounts from. Mark you, if you rent your property like that, and there's nothing against you doing that, right? But if you do that, that additional income we would not consider, all right? And before I go to the next question, see that's a rental income question, I just want to make one very key addition when it relates to rental income. This income now, you now have to declare it so that it is, when you're doing your taxes, you declare it as income, right? And when you declare it as income, it goes on your notice of assessment, because if we are claiming that you have a separate suite and you are renting it, and when the lender looks through your notice of assessment and it's not on it, then that income we won't be able to use, because any income that is not declared for tax purposes cannot be used in calculating your mortgage. Simply cannot, right? You have to, as they say in English law, if you come for equity, you have to come with clean hands, right? So you cannot, on one hand, don't declare it to the government, and then on the other hand, come and say, yes, this is income that I have that comes from a rental suite, all right? You have to declare it, and that is that. In saying that, I don't want to scare anyone that, listen, I don't want to pay more taxes, so I'm not going to declare the rental income. Especially in the case where your rental income is like a separate standalone property and you don't live there, it's a good thing to declare that income. And the reason is, even though you declare the income and you might think that it will cause you to pay more taxes, it probably won't. Because when you do that, if the property is in your name and it's a standalone rental property, what will happen is that when your taxes are being calculated, they will subtract the amount of money that you pay every month that goes to interest. So there are benefits to doing it, right? So don't be afraid. Do what you have to do. All right. So that's for that question. Then for the second question was asking if all the documents have to be signed off, and if, for example, $2,000 is charged for rent, if the mortgage payment has to be more than that. In a case where it's a standalone unit, where you're renting it and you're not living there, if you are collecting $2,000 for rent and the mortgage payment is more, then that won't benefit you, because then there'll be no surplus to use as income. However, if you are living on that property and you're renting just a part of it, so you take care of all the other expenses, that $2,000 can be added to your income overall, all right? So it all depends on whether it is a standalone unit or if it's one that you occupy a unit on the property. So say it's a multi-unit property that has 1, 2, or 3 or 4 units, then it doesn't have to, the mortgage amount doesn't have to exceed it, because you can add it then. But if it's a standalone unit, the answer is no, you can't add it because no, that will end up to be a liability for you. All right, great. Lovely questions. Love when you guys participate. All right, so investment income. All right, so investment income can come from various sources. Interest that is paid from dividend or from other forms of investment that you might do. So say you have a business on the side and you pay yourself through dividend, or you have stocks and bonds and things like that, and you are getting interest on a regular basis. Like say you have like one of those treasury notes and you get interest every month based on that, and it's set for a long period of time. Then that income can also be added to your total household income in order for you to use that to qualify when you're trying to get a mortgage. All right, so that is it as it relates to income. And before we go, we just want to give you our mortgage tip of the day. And the tip is to ensure mortgage application process runs smoothly. Ensure to get all your documents that are required in a timely manner and send those to your mortgage broker, who should be Oral McLean, the mortgage MC, right? That way we are sure that, the process will run smoothly, because when we're applying for a mortgage, time is of the essence, right? Because we have strict timelines that we have to adhere to. And why we do that is in order so that you don't pay interest costs if you don't close on time. All right, so it was again wonderful to present to you, to be here with you. I hope you enjoyed it. I hope you guys learned something new. And just to remind you that my name is Oral McLean, the Mortgage MC, and this was Talking Mortgages on HGG Radio. See you again soon. In the meantime, walk good. HGG Radio.